Welcome to the Financial Feast podcast. I'm Kevin.
And I'm Zach.
And today we're going to be talking about what the stock market is.
Obviously, when we talk about the stock market, there's a lot of different things that go into the stock market. But before we get to that, since we are the Financial Feast,
Yes.
we always talk about food. We bring a little something interesting to it. I wanted to discuss really quick what you did last week because you went on vacation.
I did go on vacation, and it's always nice to go on vacation.
It is nice to go on vacation. I'm going on vacation this next week.
Yeah, so we'll talk about that too later maybe. But I actually just went to Orlando, Florida, which right now I live in Ohio, and it is currently very cold.
Yeah, we just got like 3 inches of snow.
Yes, and so going to a warm escape was very nice.
Good decision.
We did have a little bit of a problem coming home.
I heard, but I haven't heard the story yet, so I'm excited.
So my wife and I took a little bit of a gamble. We decided when we go home, we could have another full day down in Orlando if we took a red eye home.
Good decision.
Right?
In theory?
In theory. It's like, okay, 10 o'clock, not too late,
Okay,
right?
yeah.
10 o'clock leave time. We're okay. We could do this.
And it's only like an hour and a half flight, right?
Almost 2
hours.
hours.
Okay,
Yeah,
so that's not
almost
bad.
2. But it still gets you home by midnight.
Yeah, reasonable time.
Yeah. So the other thing is we have 2 kids. Disclaimer: 7-year-old and a 5-year-old right now. And when you're thinking about a red eye, they usually go to bed at like 8, or actually earlier than that, 7:30.
Yeah.
So we're like, okay, well they'll just sleep in the airport, no problem.
Okay.
So we get to the airport, everything's good, sitting there, get there the normal 2 hours early, as we typically do. Maybe that's too early, I don't know, but with 2 kids, we decided to do it. So we get there, I get a text on my phone saying your flight has been delayed, and I'm like, okay, well, that's okay. Like, what's it look like? And they're like, it's been delayed 18 minutes. I'm like, oh, well, that's
Not bad.
Who cares?
Nothing.
That won't make or break anything.
Yeah.
Cool. So I show it to Beth. She's like, yeah, that's cool. It's not a big deal. We're like, yeah, that's cool. So we'll go chill in a gate, wait around. Well, about 20 minutes later, we get another text that says we are now leaving at 12:15.
Okay.
So now it's 2 hours.
2 hours later. Okay.
So now we're thinking, okay, well, what do we do? Obviously, you can't do anything. You're at an airport. You're kind of a hostage at that point, right?
Yeah.
So we
That's
decide,
true.
okay, well, make the best of it. That's cool. And about 20 minutes after that, we get another text.
Is this 20 minutes after the first text?
No, this is 40
this
minutes
is-
after the first
Okay,
text.
okay.
So 20-minute intervals, we're getting a text. 1, you've been delayed 18 minutes. Don't care.
Text number 2.
Text number
2
2,
hours.
2 hours.
Bigger deal.
Text number 3, it's now 1:15
Okay.
that we're leaving. That's now been a total of 40 minutes of how do we make this work? Okay, what do we do? You can't do too much. So you're just like, we just sit in the airport. That's what we do.
Dealing with a 5-year-old and a 7-year-old.
Yes.
And you guys who are
Yes.
tired.
And a hyper 5-year-old, I might add. So later, about an hour later, we get another text. Your flight has been delayed till 6 a.m.
Wow.
Yes, 6 a.m. So
What?
now we're like, okay,
And what time is this that you...
we get this text probably around 10 o'clock when we should have actually gotten on the plane originally.
Okay.
And they said your flight has been delayed till 6 a.m. And so now I'm thinking, oh, I have to sleep in an airport with 2 kids. How am I going to do this?
Yeah.
So it was a bit of a adventure when, ironically, when you have 2 little kids, you can call it that.
Yeah.
And they'll embrace it, and it is
sure.
now an adventure. And
Memories.
Yes. So we do have pictures of my wife and the kids all racked out on the floor at an airport sleeping because there was nowhere else. It was almost like there was no room in the inn a little bit. That's kind of what I was thinking for that minute. But yeah, so definitely not the most ideal way to get home.
Okay.
But we did get home.
But you got home, you're here.
Yeah.
It's a good memory.
It is. Not so
Yeah.
good a memory, but
It's a memory.
Yeah, it's a memory. And it was a great trip. Other
Yeah,
than that,
good.
it was amazing.
Good. Well, at least it was on the back end and
Right.
it wasn't on the front end.
Yeah.
And then you're like wiped out and the whole first day is just kaput.
yes.
That would have been rough.
That would have been
Not that it
the
wasn't
worst.
rough, but
Yeah.
that would have been bad
Yeah.
to start with that and then
Right.
So we're going to get into the stock market now. What I want to do is do a little bit of an outline so that way everybody kind of knows what we're going to talk about.
Yeah.
Because the stock market is kind of big topic. And what we want to do is really just kind of explain the basics and understand what the stock market is. So in preparation for this, I tried to listen to some podcasts, I watched some YouTube videos, and I found that people weren't really explaining the stock market. And I walked out of it not really knowing much more than I had entered with. So what we're going to do is we're just going to kind of quickly define the stock market. We're going to give a brief history of the stock market. Now, for those of you who are like, I hate history, all right, that's wrong.
Yeah.
History is important to know.
History is amazing.
History is it's important, and it's important here, I think, because it really gives us an understanding of why the stock market exists, and then how it kind of evolved to what it is. So I think it's interesting. I think it's helpful, and I think you will too. We're also going to talk about there's actually multiple stock markets, which I don't think a lot of people understand. There's not just a stock market. We're going to discuss that a little bit. We're going to then define the difference between a stock market and a stock index, which once again, I don't think a lot of people really understand the difference between a stock market and a stock index, and they kind of package them together as the same thing.
Yeah.
So we're going to define that, and then we're just going to go through some terms at the end that are pretty common that you may hear when people discuss the stock market on the news or on the radio, right? When different financial people are talking about terms, we're just going to define a few of them just so everybody's on the same page.
Yeah,
so
makes
pretty
sense to
easy,
me.
nice
Yeah.
and easy. All right, so we're going to start with what is the stock market? Quick definition.
Yeah, so the stock market is basically a venue where shares of companies, publicly traded companies, can be bought and sold. It can provide companies with financial support, so it can enable them to raise capital, right? And it enables them to raise that money to maybe fund further business adventures that they want to do. And it also gives the kind of common person like you and myself to own and profit off of a piece of that growing company.
Yeah, it gives us an opportunity to buy into a $1 trillion company like Apple.
Yeah.
Where you don't need to be a billionaire to have a part of this growing business. You can buy it through the stock market.
Yeah, and how did that all start? When we talk about history.
So we're going to talk about the history. I do think that this is interesting. So the idea of the stock market is probably a lot more ancient than we're going to be talking about now. I'm sure. Looking at the definition of a stock market is just a place for people to essentially do business, right? That concept, old concept, right?
Yes.
As long as
Sure.
business has been around, as long as people have been selling and buying things. But the idea of a more modern stock market, back to the 1500s, into Belgium. I'm reading because there's a lot of notes and I don't remember all the history.
Sure.
Back in Belgium, in 1531, is really where they kind of take us back to more of a modern idea of a stock market. Then in the 1600s, with the East India Trading Companies, everybody's heard of the East India Trading Companies, right, in school. Yeah. Might not know what it is, but you've heard of it. East India Trading Companies, the idea of a stock market started getting bigger, where these people who own these companies, who own the ships, who were selling the merchandise, would want to go to a location that they could meet potential buyers or even current buyers. But since they're traveling, right, and they don't have cell phones, right, they're not like reaching out to these people via social media in the 1600s.
Yeah.
They needed a location that they could meet at. So they started to kind of find these places that they could just meet at and facilitate easy business operations with their current people that they're already working with or new people. And then working forward with that idea to 1773, and the London Stock Exchange was created in a coffee house in London. So that, when we're talking about stock exchange, that's then the idea that we have now with the London Stock Exchange kind of being and for example, actually the London Stock Exchange is still existing, but that's kind of the first established real opportunity for people to really meet with a company in a very solid, well-known place that has then existed for a while. So 1790, the first American stock exchange popped up in Philadelphia. 1792, the New York Wall Street started, and we all know that still exists.
Yeah.
And it's obviously changed a little bit with technology.
Sure.
You can buy things differently. You don't need to be there physically. But the idea is still the same, right? You're meeting with these companies who have shares that they want to sell you so that they can get money, so that they can grow their business, and then you're getting a profit. And that's really all it is.
Yeah, and it's amazing how, as old as that history is, it still has kind of maintained the same idea.
Yeah,
throughout
because
the whole
it's
thing.
because it's a good idea,
Yeah.
right? It's just a basic quality thing that has been maybe enhanced a little bit with technology, but the idea is a great, solid business idea.
Yeah, and when we're thinking about stock market, the exchange, there are multiple stock exchanges actually. There's multiple stock markets, right?
Yeah, I think people think of the stock market, right?
Yes.
And that's not the case.
No, there's actually 16 different ones.
Yeah, like massive ones.
Yes, most first world countries actually do have one of their
Yeah.
own. So that includes, of course, us, Japan, Shanghai has a big one, Hong Kong, London, and the European Union has a few countries that do as well.
Yeah.
And there are so many, but the reason why there's so many is kind of important, I think.
Yeah. So the understanding that since the stock market is simply a place for companies to partner or meet with potential clients and to sell the stock that they have, the reason that there's so many different stock exchanges is because there's so many different people, and there's so many different countries, and there's so many different currencies, and there's so many different languages in the world that a single stock exchange just doesn't make sense.
Yeah.
So understanding that there's so many different things going on in the world necessitates a lot of stock exchanges.
Yeah, and that also kind of, we'll talk about a little bit later in this podcast, but diversification, right?
Yeah.
That's something that will come up with that,
Yeah.
right? And, we talked a little bit about a stock market and a market index and that there's differences.
Yeah.
So there are. And when you think of the stock market, you might think of the Dow Jones, right? You might hear on the news or the radio, the Dow was up so many points, the NASDAQ fell so many points.
Yeah, or the S&P 500.
Yeah, S&P
right?
500. Those are not the stock market.
Correct.
Yes, they are actually market indexes of the stock market. Basically, the idea of it is that they take a conglomerate of the companies, put them together, and then you have an idea of how the market performs. So the Dow Jones has 30 different companies in it. They're all what they're called large cap companies, which means they have a large amount of money in them. They're huge companies.
Yeah.
And the idea of it is when you hear that the Dow is down so many points, it's supposed to give a quick snapshot of the whole market, right? So with the Dow being down, you can kind of have the idea of, okay, in general, most stocks lost money today. That's not how it always works, but it gives you a quick snapshot. The NASDAQ has more of the tech stocks, a lot more of the tech stocks there. They also are a big conglomerate, and it's all completely digitalized, and that is an index. And then the S&P 500 is made up of only U.S. companies, 500 U.S. companies, and it has variety,
Yeah.
a lot of variety.
Yeah.
I mean, you have, I believe Amazon is still in the S&P 500, but then you also have Domino's Pizza, right?
Well, yeah, Apple, Microsoft, Google are all in the S&P 500. And just for comparison's sake, those companies are valued at over $1 trillion each,
Yeah.
which means they're gigantic, right? But then you also in the S&P 500 have smaller companies like Domino's, American Airlines, CarMax, which are at like 10, 11 billion, which is still a huge company,
Yeah.
but like a lot smaller than
Yeah.
$1 trillion company,
Right.
which is why these indexes are important. So the difference here between a stock market and a market index, right, is the stock market is the place, the venue that you're able to buy these companies in.
Yes.
Right? A stock market index the market index, which is what we're talking about with the S&P 500 and the Dow, right? These are just not examples, right? But units of measuring different types of companies, right? In the stock market in general. So the S&P 500, like we said, is 500 American companies, and it tells us how healthy, right, for lack of a better phrase, how healthy these companies are. So when you're investing and when you're looking at investing, you're looking at market indexes to figure out how companies are doing. You're not looking at stock markets to figure out how companies are doing.
Yes.
The other important thing, which is why we talked about there's so many different stock markets, is because there's a lot of market indexes, right?
Yeah.
Across the world,
Yeah.
right? So when we talked about American companies in the S&P 500, right? That's 500 American companies. There's a lot of companies that aren't included in that. Why is that?
Yeah, and when you think about why the different companies are not included in it, some of them might not meet the cap amount that's needed to be included. The qualifications to be in the index. I mean, there's the Russell 2000, which we didn't really talk about. That's another index.
Yeah, and these are all smaller. There's
cap.
2,000 companies,
Yeah.
smaller companies. I think that's American-based also.
Yeah,
right?
You got like Wingstop, Texas Roadhouse, companies like that you kind of are familiar with, but wouldn't really think twice of like checking those out necessarily to invest a bunch of money in like an Apple stock that's considered to be more safe. But spreading it out, once again, diversification, we'll get more to that. But knowing that and knowing, making sure as to why you have an idea of these indexes is important, because then it gives you more of an idea of, you might hear terms of outperforming the index.
Yeah.
Right? When someone's investing, if they're outperforming the index, you don't know what index they're referring to.
Yeah.
So it could be the
because
S&P, it could be the Russell.
So, for example, I just have a few written down, right? We have the Americas, right, that we kind of are pretty familiar with, the S&P 500, the Dow Jones, the Russell 2000, which we talked about. We all kind of hear those terms swirled around because most of us, are from America. Those are pretty common. But then we also have the Brazilian Stock Exchange. We also have the S&P TSX Composite, which are Americas, but they're South American. We have European, Middle East, and African ones, which are the CAC 40, the IBEX 35, the Euro Stock, all kinds of ones. And then there's Asia Pacific, SSE Composite, Hang Seng, sorry for anybody if I pronounced that wrong, the S&P Asia 50, all these different ones that if you're like, I'm investing in the stock market, I'm going to go into the S&P 500 and I'm only going to go in the S&P 500. That's fine. There's nothing wrong with investing in the S&P 500, but there's a lot of companies that are in, I'm not going to go through the list again.
Yeah.
There's a lot of companies that are in all these other things that aren't in the S&P 500.
Yeah.
That you're now missing out on all these other countries because you aren't investing in international, into different valuations, large, small, whatever they are. So understanding that there's different market indexes, and that's what we're then going to be looking at, and that's what we're using the stock market to invest, but we're investing in these market index companies. So I think that's important. We're going to discuss also here what diversification is. Because when we're talking about these different indexes, it's important for us to understand why it's important to have different indexes and different companies. Just even if you're only in the S&P 500, why should you not invest in only Apple? Why is there 500 companies that maybe you should put your money in instead of just, well, Apple's a great company. They're doing fantastic. I'm just going to put all of my money into only Apple, right? That's what we're talking about with diversification. So can you explain why diversification is important when we're talking about investing in the stock market?
Yeah, because, if you invest in Apple, what happens if some unforeseen circumstance happens with Apple that no one saw coming, and you have all your money there, and
bye money.
Now you have nothing.
Yeah.
And why is that important to diversify? Because of that reason. So a lot of people do like the S&P 500 because it does have 500 American companies, right? And the idea is, as some outperform others and some lag behind, you have that natural growth that happens year over year.
Yeah.
And, with the stock market, nothing's ever sure. There's no such thing as a sure thing in the stock market.
Yeah.
But there's past history.
There are trends.
And trends.
Yeah.
And diversification is so important because we're not talking about just diversifying over different index funds, right?
Yes.
We're talking about different sectors.
Good point. What are the different sectors that we need to be? What does that mean, different sectors?
Yeah. So some things you could think about would be health, right? Technology.
Yeah.
Manufacturing, food.
Yeah.
Be like food.
Yeah. Travel.
Yeah.
Right. All these different
Travel.
things.
Yep.
Yeah.
And these different sectors, when you spread your money across them, if the food sector, for whatever reason, is doing poorly, hopefully maybe the technology or health sector kind of helps counterbalance that. So
Yeah.
company sizes, another thing to think about with diversification. You have what they call the large cap, small cap, and then the growth.
Yeah, and we're gonna get into we're gonna try to do a couple stage series of
Yes.
this, and we're gonna explain more how to invest later. We're just kind of explaining this. So if you're like, well, I don't know what large cap
Yes.
value, small cap, what does that mean? We're not gonna explain all that today.
No.
We're gonna get into it
We will.
because that's important to know. It's just maybe not as important right now.
Yeah,
But-
yeah, and even continue with diversification, even diversifying over countries, right?
Yeah.
You don't want to just be U.S. What happens if there's huge growth in the European Union area and you
Correct.
could have been in on it, but you were only in the U.S. and diversifying across to hedge your bets, so to speak, is important.
Correct. Yeah, I mean, and really, it just makes sense. I think it just naturally goes with people once you understand the concept of diversification. Hey, I don't want to put all my eggs in one basket because if something happens to said basket, my eggs are kind of stuck, right? If I have 10 eggs and I put one in 10 different baskets and a tree falls on one basket, I still got 9 eggs. If I have it all in one basket and a tree falls, all my eggs are kaput.
Yeah.
So we understand this idea and we understand why it's important. But then when we actually go to put our money into the stock market and we see a company that we really like, it's really tempting just to go with that one because we're not thinking about all the things that really play into it. So understanding diversification is really important.
Yeah, that might be the most important thing when it comes to building a stock portfolio.
Yeah. So what we did so far is we tried to just define what the stock market is, right? Give a quick definition. We gave a little bit of a history about it, why it happened, maybe to help us understand a little bit about where we got to, or I guess how we got to where we're at. We then discussed a little bit about the difference between a stock market and a stock exchange or a stock market index and understand the difference between those. We talked a little bit about diversification. What I wanted to do last is I wanted you to kind of walk through a couple different terms that you think are important that when we're talking about stock market, people might hear these terms and they could be confused because
Yeah.
they're confusing.
They are. Some of them are. And you don't hear them every day, right?
Yeah.
So you don't know. But some people might have heard of a bear market.
Or you do hear it every day, but in a different context.
Yeah.
Right? Because
That's
we
right.
all know what a bear is.
Yeah.
We all know what a bull is.
Yeah.
But then you're thinking about what's a bear market and what's a stock or bull market.
Yeah.
Well, I don't know.
Yeah, which one's good?
Yeah.
Which one's bad?
Yeah.
Right? So the bear market is the bad one. Okay. That means there's been a decline of about at least 20% over a sustained period of time.
Okay.
So it's typically 2 months or more, but it can predict it a bit based on what is happening in the economy. So you might hear some economists saying, we foresee a bear market in our future, not so far away. They're using data to kind of predict that. And then a bull market's the opposite. It rose to 20% from a recent low.
Yeah.
And once again, about a 2-month period. And they're typically not predicted because you can't really predict when it's going to go up as easily.
Makes sense.
And,
Because there's not really trends.
Right,
Right.
right.
By April, usually the stock market's doing great. I mean, that's not really the case.
not always the case. There
Yeah.
are some different areas that are kind of constants, but most of it is variable. So
Yeah.
it is really hard to know that.
So when I hear bear market and bull market, something that I think through that might just be helpful when I think of up and down, how do bears attack? They're usually taller than you. They swipe down at you, right?
Yeah.
So bears swipe down at you.
Yeah.
Bear down. Bulls tilt their head and then they come up at you.
Yep.
Bull good. I don't know.
Yeah,
If
I mean,
it makes
that's a good
sense.
way to-
It helps
that's a
me
good
in
way
my
to think
mind.
about it.
So
I
there you
like
go.
it. I like it. I never heard that one before,
Yeah.
but that I'll remember it even better now. I like it. Another term is a correction. You might have heard of a market correction. Typically, it's a decline of about 10% or more in the price of a security, which is another word for stock or something you may own. It could be a bond, other
Which,
things.
once again, weird because correction sounds good.
Yeah,
Correction is not good.
it's not.
Yeah.
It's not good. It's, it's like,
It means it's going
It's
back
almost like
to
a-
what it should be. There's an anomaly, and it was doing better than expected, and it corrected back to the normal.
yes, due to supply and demand, maybe.
Yeah.
It could be a variety of factors. But 10% or more in its most recent peak, they'll call it a correction.
Okay.
There's also recession.
Okay.
And that's typically 2 quarters of stagnant or no growth. And that could be defined as 2 business quarters, which is typically would be like July to December or January to July. That'd
Okay.
be 2 quarters there.
Okay.
And that would mean that the GDP or the economy itself hasn't grown for 2 quarters.
Okay.
And then that would be a recession. Another thing you might hear of is an IPO, which is defined as initial public offering. I think the most interesting thing people don't think about when they hear IPO is that they might hear, okay, say Walmart is going to an IPO, and that means that they're going to be publicly listed on the stock market, which means now you can buy a share of Walmart. So some people might line up thinking, oh, I think in 10 years Walmart's going to do great, so I'll buy a lot of shares now and then hold it for a long time, and then I'll have, a lot of money, hopefully, is the goal, right?
Yeah.
But initial public offering just means that company raised a lot of money with a big bank on Wall Street. So that could be Goldman Sachs, JP Morgan, the big names, Wells Fargo. And what happened is they just got a lot of money straight up, and then the bank now owns that percentage of the company. So that when you're buying a stock in it, you're not actually paying Walmart that money. So if you buy, we'll make it simple, say you buy 1 share for $10. You did not just give Walmart $10. That's not how it works.
Goldman Sachs.
You gave Goldman Sachs that money.
Yeah.
And Walmart's allowed to do buybacks, and that can get more complicated. But basically an IPO is just basically where a company raises money for their company.
And it's where they go from being a privately held company where one dude owns it to now they can offer it to the public, which allows them to get more funding, right?
Yes.
So that's why they want to do that.
Yes.
So they can grow their company.
Yeah, they might want to expand into more stores,
Yeah.
Depending on the business, but there's a lot they can do with it. And
Yeah.
it's a big influx of capital
Yeah.
for them, which is nice.
Yeah.
So I guess to summarize, right, those are some terms you might hear, and maybe now, hopefully, you will have some idea of what they mean
Yeah.
if you didn't before.
I mean, pretty common, pretty simple, really. I mean, doesn't need to be that complex. The stock market, pretty basic. I mean, thing. It's just a place for businesses to meet potential customers, right? To buy and grow their business. I mean, that's really it. And then there's some more detail to it, but I think a lot of people make this so complicated and so overwhelming, and I mean, it can be. So I don't want to denigrate anybody because they're overwhelmed, but that's what we're trying to do, is just kind of simplify these terms and make them more understandable, so that way when somebody kind of works into understanding and wants to understand this a little bit more, they don't feel so overwhelmed that they feel like they can't do it.
Agreed. And we'll be talking next week on more how do we get into investing in it? What does that process look like? And a few other things kind of in this little mini-series we're going to be doing.
Yeah. So thanks for coming on. Thanks for listening to our podcast. We have, you can run through all the stuff that we have where they can go.
Yeah. So we have a good website, financialfeastpod.com. You can join us on our Facebook group under the same name. We're also on YouTube, so find us there. And we're wherever you get your podcasts, Spotify, Pandora, wherever the case may be, we're there as well.
Yeah.
So we hope to see you again next week.